IPOs have taken the market by storm as of late, with companies like Snowflake, Palantir, DoorDash, and Airbnb all going public recently. All this begs the question, should you invest in an IPO in 2021? To answer that, I'll cover everything IPO related, from the mechanics of how and why companies IPO to an analysis of IPO trends historically. I'll also take a dive into the December 2020 IPO class to see what insights we can get. A company's IPO, or initial public offering, at the highest level is a fundraising event. A company issues shares that are sold to an underwriter and then subsequently released to the public markets. This opens the shares up to the investing public. There are, of course, other reasons a company may choose to IPO. The other main one being liquidity. It gives employees and early investors the ability to exchange their shares for cash. If a company remains private, they're not able to monetize the shares they own, as these shares are essentially illiquid. Another reason a company decides to IPO could be to gain broader exposure to more investors and the general market. Let's take a look at the number of IPOs per year in the United States from the year 2000. Now, as you can see, it's an event that occurred more in 2020 than in any other year in the last 20 years. And what's also important to note is the second highest year was the year 2000, the year of the dot-com bubble. Let's first quickly go over how an IPO actually works. Basically, the company sells its shares to a lead underwriter. The underwriter is an investment bank. Think Goldman Sachs, JP Morgan, Credit Suisse, and these kinds of firms. The underwriter has the duty of coordinating the underwriter syndicate, doing due diligence on the company, coming to a price agreement, organizing the lockup agreements, and being the lead seller of shares in the public markets. Don't worry, we'll explain all of these in the video. The lead underwriter, in essence, is the lead coordinator of an IPO from start to finish. Think of them in football context as, say, the football manager. The syndicate is a team of investment banks and brokers. This team is assembled and given guidance and a game plan from the manager, aka the lead underwriter. Once the team is strategically selected and assembled, the investment banks and brokers are given shares to sell. A roadshow then occurs. These are a series of presentations that are ultimately sales pitches to investors. It is done to gauge interest, increase awareness, and assess what the price should be for the IPO listing. Ultimately, a price is agreed by both the underwriter and the company. This is what we refer to as the IPO price. This is the price that the new shares initially sell at before they are released to the general public. Yes, you heard that correctly. The price is agreed to by the company. Therefore, the board of directors, which typically include the largest shareholders, are agreeing to the price with the underwriter. This is very important to understand and something we'll touch on later. So, who can purchase shares at the IPO price? Well, the team of investment banks and brokers reach out to institutional investors, mutual funds, insurance funds, and high net worth investors. Everyone who purchases these IPO shares are considered to be participating in the IPO. This means you purchased the shares before they've actually been released to the general public. Here is a graph showing the IPOs in December 2020 and their day one price movement. Looking at the graph, you can notice an average 100% gain on day one of trading. Now let me be clear here. The people who are making these 100% gains on day one are the people that are actually participating in the IPO. The general public and retail investors like you and me will be lucky to get an order filled anywhere near the actual IPO price. In the case of Airbnb, I spoke with a broker and he mentioned his clients were only able to get a price accepted in the $140 to $160 range on day one of Airbnb's trading. Now, Airbnb had an IPO price of $68, so this is substantially higher for the retail investors like you and me. Therefore, it's only those participating in the IPOs that are actually realizing or able to potentially realize those 100% gains if they decide to sell. Now, I bet everyone is saying, wouldn't it be great to be best buddies with a big rig Wall Street underwriter? Well, sadly, we're not all that lucky. Now, I'm going to explain why we might be seeing some of these crazy day one gains. Let's remember, the primary goal of an IPO is typically to raise money. So let's look more closely at Airbnb's example. The company issued 51.5 million shares to raise funds. Their goal is to get the highest price possible for these shares. At a $68 per share price, they were able to raise $3.5 billion, which they felt was a very fair valuation for the shares. This priced Airbnb at $47 billion. However, on day one, the public valued these shares at $144 per share, valuing the company at $100 billion. So Airbnb basically lost out on $3.5 billion worth of cash based on the public's valuation of their company. So they left a lot of money on the table. So why did they agree to this $68 price per share? Well, to put it simply, they actually thought it was a good deal for them. A $47 billion valuation was a significant uptick from their April 2020 valuation, only 8 months ago, of $18 billion. So the shareholders believed $68 was a fair price to sell to the underwriters. Yet the public doubled that in one day. This means that the public valued the company at double times what the insiders valued it at. This sounds very backwards, especially for a company that doesn't have a very long track record of disclosed earnings. Somehow, the people who know the least about the business are valuing it 2 times more than the people that know the most. Keep in mind, the winners in this are those who participated in the IPO, not the retail investors who bought on the public markets on day one. As evident from this graph here, we can see that the public are valuing securities at a much higher price than the insiders themselves. So why is this occurring? Well, it's the first chance for your average investor to get in on these stocks. If you want to see a comparison, check out what hype and momentum can do on a video game company in the video above on CD Projekt. In 2020, more people are accessible to trading than ever before, as we have an abundance of commission-free or low-fee services. Retail investors in 2020 account for approximately 25% of trading volume. By contrast, in 2019, that number was only 10%. So this is a massive jump. The Robinhooders, as we call them, have a serious impact on stock movement and stock prices, which isn't something that was common before. These new investors are typically not fundamental investors, and they're typically more hype or momentum investors. And there's nothing wrong with that at all. In fact, we at Behind the Money consider ourselves hybrid investors. So we like to use a combination of different signals before we make a stock move. Another reason for this IPO boom may be related to the industry. Healthcare and tech have seen many IPOs in 2020, and they've been both very, very hot sectors. Healthcare-related endeavors have taken off during COVID, as the world has practically become more health conscious overnight. And tech has continued to outperform other sectors as it has for the past 12 years or so. In the past, it was often the large institutions that had the massive amounts of buying power, and they were more fundamental in their approach, looking at bottom line numbers. But with the FANG stocks dominating the investment world, accounting for approximately 15% of the S&P 500, it shows that you can have success in investing early in public companies that aren't turning profit, and instead aggressively focusing on top line growth. Just take a look on the return of the FANG stocks since their IPO. Clearly, these have had an impact on the psychology of the modern day investor. Then there's the ever so popular ARK investment funds of the world. Funds that have performed better than almost all the other funds by focusing primarily on top line growth. ARK funds, the FANG stocks, 100% Tesla options, these are things that have made people a lot of money lately. Many are enviable of these traders who have struck gold with these strategies. We look at these graphs and we think, imagine if I could have gotten in at the start. Because of this, we seem more inclined than ever to jump in on day one of an IPO. But even the FANGs weren't churning out 100% on their day one IPOs. As you can see, the IPOs of what many people consider the most game-changing businesses and greatest investments over the last 20 years, combined on day one of their IPO, only went up 8%. Taking out Facebook's 50% drop, the average of the others combined would have still only been 22.5%. Now compare that to December's IPO gains of 100%. Well, that's quite the contrast. In the FANG examples, it's saying the market and the general public were actually valuing their businesses more at par with the company and the insiders themselves. And this makes sense. So why isn't this occurring in December of 2020 or 2020 as a whole? It is clear people are looking far into the future to price these current IPOs. I've seen some analysts using discounted cash flow valuations to value out till 2030. This is some serious guesstimating using these kinds of time horizons to value a company that we have very limited historical data for. It's a good practice as you'll get to understand the business, but to think you'll get an accurate picture of how things are going to look 10 years down the road from now is a little bit silly. One thing is clear though, and that's whatever valuation method people are using, they are certainly paying up. In fact, in many cases, double what the insiders believe the stock's actually worth. These levels of optimism are things we've actually seen before. Think the dot-com boom. And by the way, the peak of that boom in 2000, as we mentioned before, was the second most IPOs in the last 20 years behind, well, 2020. We all know some companies can justify higher multiples based on their growth prospects. But when almost every company in many different industries are trading well above their historical valuations, that is when things get, well, a bit dicey. Meanwhile, what we've seen recently in day one of IPOs is investors seem to be picking them all as opposed to only the best. We encourage investors to pick the best, but don't pick them all. See why in Gavin's video above. So I've explained why I believe prices are going up 100% or more in recent IPOs. It primarily comes down to the fact that we have today more retail investors than ever before. And these investors are looking far into the future and they have extremely optimistic outlooks of the future. Perhaps thinking that once the vaccine is out to the masses, that every company will be racking in the dough and growing like never before. As well, it is clear that more people are jumping on the trends and the hot stocks. And a bundle of hot stocks right now are IPO stocks. Look at the graph over here from 2015 showing the S&P 500 returns versus the Renaissance IPO ETF returns. They are mirrors of each other until this year. And what we see this year scares me. And if it scares you, smash the like button. Now, I'm going to go over some strategies for investing in IPOs in 2021. Firstly, I believe that as a public retail investor that isn't participating in the IPO, investing in an IPO in day one is a flawed idea. One of the reasons for this relates to lockup periods. Typically, the existing shareholders are forced to keep their shares for 90 to 180 days. History has shown that the expiration of these IPO lockups usually result in a dip in the stock price. Existing shareholders can finally put their shares on the open market, thus creating a large float of shares available. In this case, the supply often exceeds the demand, which drops the stock price. Often, investors prepare for this by deciding to sell some of their shares before this lockup period, but this actually also propels the shares in a downward motion. Uber and Beyond Meat are two examples of high-profile companies which suffered from this lockup price movement. Basically, instead of investing in the IPO in day one, you can almost always get in at a lower price later, often around the lockup periods. Another reason why investing on day one of an IPO could be flawed is because there could already be a better public company available. Are the IPO companies really so much better than the existing ones? Or is it just the buzz and hype around the IPO that is temporarily pushing the prices up to an unrealistic valuation? In the case of Airbnb, you could invest in, say, Booking.com. Let's look at some data to compare the two companies, and you can tell me what you guys think in the comments below. As you can see, when comparing gross bookings, Airbnb is on a similar trajectory to what Booking.com was 6 years ago. This isn't a bad sign at all for Airbnb, as Booking.com has done a great job in rewarding their shareholders. Revenue is around 8 years behind, but again, growing at a comparable rate to that of Booking.com. Now, what isn't as promising is the EBITDA growth. As you can see, it isn't closely resembling that of Booking.com, as was the case for revenue and gross bookings. This could be concerning, but as mentioned before, we have seen very successful companies not turning profit initially as they focus on top-line growth, so it's not a deal breaker. What trumps everything, though, is valuation. Being 6 years behind in gross bookings, 8 years behind in revenue, and not even remotely close in EBITDA, how can Airbnb's current market cap be equivalent to Booking.com's today at $85 billion? For perspective, Booking.com's valuation 8 years ago was $30 billion, and 6 years ago it was $60 billion. So you have a business today that is 6 to 8 years behind Booking.com in both gross bookings and revenue, and it's not even remotely close in EBITDA. Yet, right now, today, they are worth the exact same amount of money, around $85 billion. How does that make any sense? Well, it's simple. Booking.com isn't considered the Uber of the hotel or accommodation industry. Therefore, my point is completely flawed. Joking aside, I'm not saying Airbnb is a bad investment. It certainly has some advantages. They have great brand recognition, spend less on marketing per revenue dollar, have rebounded well from COVID, in fact, better than that of their competitors, and their growth rate is actually quite good. They also have more pricing power per booking as they're not dealing with massive hotel chains which can negotiate them down on their rates. Airbnb also boasts that their properties differentiate themselves from the rest, as you can book igloos, tree houses, boats, and more. But Booking.com and VRBO are increasingly attracting similar listings, therefore this advantage, in my opinion, and this differentiating factor is lessening. Which stock will outperform the other? Only time will tell. Let us know which company you'd prefer in the comments below. Personally, I think both will have a very bright future in the accommodation industry and will reward their shareholders over an extended period of time. One thing is certain for me though, I would struggle to pay 2 times what the insiders believe the company is worth on day one of their IPO day. So please, for investing in IPOs in 2021, be cautious. You saw the graphs. We may be in an IPO, I don't want to say the B word, but bubble. Some companies are surely to benefit their shareholders over the long run. But would you rather get in around the lockup period when the dust settles and perhaps once you've seen one of their first earning reports as a public company? That strategy may not only mitigate risk, you may end up actually getting in at a better price. Also, if Airbnb or DoorDash or any of the other ones at that matter are to perform like the FANG stocks and they just continually rise and rise and rise, you still are able to get in at a later date and reap much of the upside. Let's be real. How many people have you heard say things in 2016 like, oh, I wish I could have invested in Amazon in 1997? They say things like this as if they've missed out on everything. Well, if those people were to have just purchased Amazon in 2016 for $600 a share, those shares would now be worth $3,000. Good for a 500% increase over 5 years. Not bad. The rush for the general public to get in on the IPO in day one is hard to justify on any given year. But from what we're seeing right now, it's even tougher to justify. Look for direct listings to become more popular in the near future if we continue to see these IPO trends. I can't see companies willing to continuously leave money on the table like we've seen so far this year. Soon, they may realize that there's enough appetite from the public that they can do without the roadshow and the underwriters. In this video, you learned about why companies raise money through an IPO, the current trends regarding day one IPO movement, why we may be in an IPO bubble, and what you should consider while investing in an IPO in 2021. Thanks for watching. Please share your thoughts in the comments below. As always, please subscribe and hit the notification bell so that you know when our next video is out. Disclosure, we do not own any Booking.com or Airbnb securities. As always, keep in mind, this is not investment advice. These are merely our opinions and meant as educational content only. Please do your own due diligence. Until next time, thanks guys.